U.S. single-family home sales increase in December. The European Union extends sanctions on Russia for another 6 months. And Syria's central bank instructs commercial banks to unfreeze accounts except those under control. You're watching Qnews and this is the Economic Bulletin. I'm Henny Saif and we'll bring you the latest developments shaping the global economy. From key market trends and financial updates to regional economic highlights and forecasts, we provide essential news and analysis to keep you informed. Welcome back. We'll start off with the latest released data as the U.S. single-family home sales rose unexpectedly in December, indicating that the housing market regained strength at the close of 2024 despite the challenges posed by rising mortgage rates. The Commerce Department's Census Bureau reported that new home sales increased by 3.6%, reaching a seasonally adjusted annual rate of 698,000 units. November sales pace was revised upwards to 674,000 units from the previously reported 664,000 units. China's industrial profits continued their downward trend in 2024, falling by 3.3% for the year, marking the third consecutive annual decline. This follows a 4.7% drop in the January to November period, and contrasts with a smaller 2.3% decline in 2023, while profits grew 11% in December compared to the same month last year. The overall performance was underwhelming. The National Bureau of Statistics attributed the decline to factors including falling factory gate prices and weak domestic demand. In Europe, Goldman Sachs projects a slowdown in euro area unemployment growth through 2025, with growth potentially falling to 0.05% by the year's end. The firm attributed the slowdown to factors include the end of low real labor costs and a return to the historical relationship between employment and GDP. It also expected labor supply growth to slow, with immigration being the primary driver. Despite a balanced labor market, risks remain for a higher unemployment rate, especially if job vacancy demand softens further. German business morale unexpectedly improved in January, with the IFO Institute's Business Climate Index increasing to 85.1 from 84.7 in December. This was driven by a more positive assessment of the current economic situation, although the expectations index fell slightly to 84.2. Despite the improvement, many companies remain cautious about the future due to political uncertainty ahead of Germany's snap national election on February 23rd. The French National Institute of Statistics and Economic Studies has reported that the country saw a 6% increase in the number of startups in 2024, with 1.1 million companies created. This marks a 5.7% rise compared to 2023, despite a decline in new company registrations at the end of the year. The institute noted that small business startups rose by 7.3%, while new company formations grew by 5.4%. However, the number of individual businesses decreased by 3.2%. The European Union has extended its sanctions on Russia for another 6 months following Hungary lifting its objections after securing energy security assurances. The sanctions, which include trade bans and the immobilization of Russia's central bank assets, aim to deprive Moscow of funding the conflict with Ukraine. Hungary had initially stalled the renewal, citing concerns over Russian gas supply, but agreed after receiving commitments from the European Commission to protect energy pipelines. The sanctions are also critical for financing Ukraine's $50 billion loan, supported by G7 profits from frozen Russian assets. European Central Bank President Christine Lagarde has raised concerns about increasing political influence on central banks, warning it could undermine the ability to control inflation and lead to economic instability. Speaking at a Hungarian central bank conference, Lagarde emphasized that despite the prevalence of formal independence, real autonomy is being questioned in several parts of the world. Lagarde cautioned that political interference could trigger a vicious circle, increasing exchange rate volatility, raising bond yields, and amplifying economic uncertainty. She stressed that managing independence will be increasingly challenging for central banks.
Than signaled at its previous meeting. In line with our strong commitment to our price stability mandate, the Governing Council took further key steps to make sure that inflation returns to our 2% target over the medium term. We decided to raise the 3 key ECB...
On the same note, Peter Kazimir, Slovakia's central bank chief and ECB policymaker, has forecast increased conflict between governments and central banks as they grapple with inflation. Speaking in Budapest, Kazimir noted that finance ministers and central bank governors are no longer aligned, particularly as inflation remains high. He warned that the temptation to blame central banks for inflationary pressures is strong, especially after years of low rates that were once beneficial to finance ministers. As inflation rises, central banks may face greater scrutiny, further straining relations with governments. German Chancellor Olaf Scholz welcomed former U.S. President Trump's plan to increase oil and gas production, seeing it as beneficial for lowering energy prices in Europe. Scholz emphasized that the added supply would support Germany's transition to climate neutrality. He also praised the continued expansion of U.S. liquefied natural gas terminals, a policy opposed by President Biden. However, Scholz criticized Trump's withdrawal from the Paris Climate Agreement, calling it frustrating and reaffirming Germany's commitment to climate action. On Trump's potential tariffs on EU goods, Scholz stated the European Union would respond collectively, defending its interests.
Ein fröhlicher Vorweihnachtsabend auf dem Weihnachtsmarkt von Magdeburg verwandelte sich in einen unvorstellbaren Albtraum. 5 Menschen sind auf grausame Weise getötet worden, mehr als 200 wurden verletzt.
Still in Europe, how will the European Central Bank navigate economic pressures as President Trump's tariff threats loom over the Eurozone? And what impact might this have on future monetary policy?
The European Central Bank, ECB, is set to hold its first meeting on Thursday since US President Donald Trump's return to office, with tariff threats looming over the Eurozone economy. Economists predict the ECB will cut its key deposit rate by 25 basis points to 2.75%, marking a continued shift from restrictive monetary policy. President Trump has warned of potential tariffs on countries manufacturing outside the US, including EU nations, but economists say the ECB outlook remains unchanged. ECB President Christine Lagarde recently downplayed concerns about U.S. policies exporting inflation to Europe, emphasizing growth risks over inflationary pressures. Traders expect nearly 4 rate cuts from the ECB this year, with forecasts suggesting rates could fall as low as 1.75%. However, some policymakers caution against aggressive easing, urging a more measured approach. Inflation in the Eurozone rose to 2.4% in December, primarily driven by energy prices, but the ECB views the increase as manageable. Chief economist Philip Blaine expressed confidence that wage growth will slow, reducing inflationary pressures. The ECB's decisions will also depend on the U.S. Federal Reserve's actions, with analysts noting that a pause in U.S. rate cuts could influence the ECB's path ahead.
And joining us from London is the CEO of Quorum Centre for Strategic Studies, Mrs. Tarek Rifai, to discuss the latest economic developments in the Eurozone and the European Central Bank's coming decision on interest rates. Mr. Rifai, welcome to the Qnews Economic Bulletin. Sir, how do you view the European Central Bank's decision to cut its deposit rate by 25 basis points? Is it the right move, or is it too conservative given the current economic climate?
I think it's the right move, and if you look at the ECB and how they've been moving on this interest rate reduction path, they've actually been moving pretty steadily and pretty consistently, unlike the Federal Reserve, which pauses and makes a decision. The ECB signal has been pretty clear, so the upcoming rate cut, which is expected for this week, I think is expected, and I think it's on the right path because economically, the Eurozone economies are growing below what their target rate is. At the same time, inflation is still above the target rate.
Mm-hmm. Well, then how could President Trump's tariff threats impact the Eurozone and the ECB's ability to manage inflation and growth?
Well, obviously, nobody wants to see a trade war, and if we do see increase in tariffs, it will affect the ECB, I think, more, or the European Union more than it would affect the US, just because the European Union right now is at a weaker economic growth trajectory than the US is right now. So any increase in tariffs or trade wars will affect them directly, and it may lead the ECB to increase its interest rate reduction going forward to help balance out the increase in tariffs, which will result in an increase in inflation as well.
Then what challenges does the ECB face in navigating the differing opinions within the governing council on the pace of rate cuts?
Well, as I said, the pace of rate cuts as it stands right now has been very steadily and very predictable, which of course markets love. However, if we were to see a trade war or any kind of escalation in trade relations, that could put this in doubt. And of course, investors do not like uncertainty, and this could create much more of a policy headache for the ECB than it is right now.
Mm-hmm. Mr. Rifai, now the Eurozone inflation is rising to 2.4%, largely due to the energy costs. How can the ECB address inflation without worsening the growth risks?
Well, we've already heard the current U.S. president state that he wants to see energy costs come down. Already indicated that he's willing to help out the European Union in terms of exporting energy to Europe. So all of these will help in the rising energy costs. And of course, if back to the past year, one of the driving forces behind the reduction or the decline in the high inflation rates that we saw was because energy prices have come down dramatically, especially when we're talking about natural gas in Europe. So I think if this continues, yes, it will reduce the pressure on inflation. And that has been one of the main reasons why we see the cost of doing business in Europe, especially for the manufacturing companies like Volkswagen, like BASF, which have been complaining about high energy costs and trying to switch their production to other countries. Now I think that might be coming to an end, and of course, lower energy costs will be a huge benefit for the European Union.
So how much influence do you think the Federal Reserve's policies have on the ECB decision? How dictating is it, especially regarding the rate cuts or the pauses?
Well, ironically, when we talk about rising rates or lowering rates, historically, we've seen the Federal Reserve lead the markets or lead other central banks higher or lower. However, in this case, we saw the ECB was the first major central bank around the world to start lowering interest rates last year. So I think the ECB is pretty independent from the Federal Reserve. So any direction the Federal Reserve goes at this point, I think will be fairly independent from the ECB decisions, which I think is positive.
So you've mentioned that nobody wants to see any trade wars, but could the ongoing US-European Union trade tension shift the ECB's focus more towards managing external economic risks than internal ones?
That's always a concern, and I think, the ECB obviously has some internal problems. If you look at the labor force and other economic factors, as I mentioned, rising energy costs was a big decision why some German manufacturers have either shut down, lowered production, or moved production overseas. So if the ECB or if the European Union would like to see some of these problems solved, they need to look internally first. However, I don't think that a trade war between the US and Europe, if it were to happen, like rising tariffs, etc., I don't think it will last long. I think it's in both parties' interest to try to resolve these matters, amicably and agree to terms quickly. So if there is any kind of rising tariffs, I think it will be short term. Long term, it's bad for everybody.
Mr. Tariq Rifai, the CEO of the Quorum Center for Strategic Studies, thank you very much for joining us. And now we move to the latest developments in the MENA region. According to the Gulf Cooperation Council's 2023 Foreign Trade Report, the GCC ranked 6th globally in trade volume in 2023, with 3.4% of global goods trade valued at $1.5 trillion, a 4% drop from 2022. It ranked 3rd in merchandise trade balance at $163.7 billion, a 57.1% decrease, and 5th in global commodity exports at $0.8 trillion, down 14.5%. Merchandise imports rose 13.4% to $0.7 trillion. Commodity exports fell 14.5% to $823.1 billion, while oil exports dropped 20.5% to $525.5 billion. China was the top trading partner, with $297.9 billion in trade, importing 19.2% of GCC exports, a 16.8% decline, and accounting for 21.2% of imports, up 10.8%. Saudi Arabia's Minister of Economy and Planning, Faisal Al-Ibrahim, announced that the country will host a recurring high-level World Economic Forum global meeting in Riyadh starting in spring 2026. The Riyadh-based event will provide a platform for global leaders, experts and decision-makers to address critical global issues and foster collaboration across sectors. Al-Ibrahim emphasized the significance of the kingdom's role in driving global dialogue, while Rende expressed optimism about future developments. This follows the success of the WEF special meeting in Riyadh in April 2024, strengthening Saudi Arabia's position in shaping global agendas. The Information and E-Government Authority has reported that Bahrain's non-oil exports decreased by 1% in the fourth quarter of 2024, totaling 1.002 billion Bahraini dinars, compared to 1.01 billion Bahraini dinars in the same quarter of 2023. Non-oil imports saw a 1% increase, reaching 1.49 billion Bahraini dinars. Non-oil re-exports surged 13% to 212 million dinars. The trade balance showed a deficit of 277 million dinars in the fourth quarter of 2024, compared to 275 million Bahraini dinars in the same quarter of 2023. A document has revealed that the Syrian central bank has instructed commercial banks to unfreeze accounts, except for those follows the ousting of former President Bashar al-Assad on December 8th. Since then, an interim government has been established and efforts to trace financial flows tied to Assad and his allies have been underway. European Commission has confirmed it will continue discussions with Ukraine on natural gas supplies to Europe and will involve Hungary and Slovakia in the talks. This follows the halt of Russian gas supplies through Ukraine on January 1st, after the expiration of a transit contract. Hungary and Slovakia have called for the EU to intervene and facilitate the resumption of gas flows to ensure the bloc's energy security. The Commission's involvement aims to address these concerns and ensure stable energy supplies for European Union member states. Oil prices edged lower on Monday after the U.S. pulled back from initial sanctions threats against Colombia, reducing immediate concerns over oil supply disruptions. Brent crude futures fell 0.51% to $78.10 a barrel. U.S. West Texas Intermediate crude was down 0.55% at $74.25. The White House said late Sunday that the U.S. swiftly reversed plans to impose sanctions and tariffs on Colombia after the South American nation agreed to accept deported migrants from the United States. Gold prices declined over 1% on Monday, retreating from near-record highs seen in the last session, as investors liquidated bullion positions, along with a broader market sell-off sparked by rising interest in Chinese AI startup DeepSeek. Spot gold was down 1.1% at $2,741.39 an ounce. Prices had risen to near-record high levels on Friday. U.S. gold futures fell 1.2% to $2,744.40 per ounce. Bitcoin fell below $100,000 on Monday, marking its lowest point in 11 days. Bitcoin was priced at $98,852.17, down about 6% on the day. This decline was driven by market caution following the surge in popularity of Chinese AI model, which spurred a sell-off in Western AI-related stocks. The cryptocurrency, which had briefly surged above $100,000 after U.S. President Donald Trump's election, struggled to maintain its momentum. The Mexican peso depreciated after U.S. President Donald Trump revealed plans to impose tariffs on Colombia, reigniting concerns about his trade policy. The currency, one of the most liquid in global markets, dropped 1%, trading at 20.463 units per dollar compared to Friday's London Stock Exchange Group reference price. The tariffs, part of a broader series of retaliatory measures, follow Colombia's rejection of 2 U.S. military planes carrying deported migrants. In the global markets, stocks were down sharply on Monday on concern about an artificial intelligence stock bubble popping because of the emergence of Chinese startup DeepSeek. France's CAC 40 dipped 0.12% and Germany's DAX declined 0.37%, while Britain's FTSE 100 inched up 0.07%. The future for the S&P 500 was down 1.71%, and that for the Dow Jones Industrial Average inching down 0.07%. Hong Kong's Hang Seng went up 0.66%, while the Shanghai Composite inched down 0.06%. In Tokyo, the Nikkei 225 index was down 0.92%, and Australia's S&P ASX 200 rose 0.36%. These are all the news we have for now, but here's a reminder of the stories we've been covering. The U.S. single-family home sales increase in December. The European Union extends sanctions on Russia for another 6 months. And Syria's central bank instructs commercial banks to unfreeze accounts except those under control. This concludes our economic bulletin for today, but please don't forget to follow Q News on YouTube, Facebook, X, Instagram and TikTok at QNewsEGY to stay informed. Thank you for watching and stay tuned for more updates here on Q News.